Hi, welcome to the Broad Investors channel, the channel for the modern day investor just like you. My name is Amin, and in this video we cover the 5 top dividend stocks in the United Kingdom. Right, the platform I use to invest into the stock market is a platform called Freetrade. I am not affiliated with the platform. However, if you do click on the link below, you could get a free share worth up to £200. The reason why I use this particular platform is that they are for free and will not charge you an arm and a leg to invest into the stock market. I've trolled through hundreds of companies in the UK and have found these to be the top 5 dividend payers. Not only are they good dividend payers, but I believe there's a future with these companies, hence why I am talking about them in this video. Now, remember, these videos and future ones are for educational purposes. So without further ado, let's get into the video.
Now, what is dividends? I won't dwell on it too much. Dividends is a distribution of profits by a corporation to its shareholders. When a corporation earns a profit, it is able to pay a proportion of the profit as a dividends to shareholders. Because of this, there are many investors that are looking at a share for its income potential. So a lot of investors look at the stock price and its dividend yield. We'll explain what a dividend yield is in a second, and they use that as a potential income for themselves. Right, so a dividend, as you know, is a portion of a company's profit. It is depicted as a percentage. This is known as a dividend yield, and it's basically the dividend yield is the annual dividends divided by the stock price times by 100, and you get a percentage. And that's it. Now let's start with the fundamental of dividend investing. And for most of you, this graph might be new. You might not have seen it before, but this is the main driver of dividend yield, or rate, as some of us call it. This is called the risk-free rate, and this is the risk-free rate on investments in the UK. The risk-free rate is the building block for estimating both the cost of equity and capital. So if the risk-free rate increases, this would result in other rates to increase, such as the dividend rate. But at this moment in time, as you can see from this graph, the UK risk-free rate is pretty low. It's at 1.1%. Now, this is why your savings account interest rate is so low. The risk-free rate is also pretty low, so your savings account interest is also pretty low because it's part of the risk-free rate. Okay, so now that you know that, let's move to the golden rule and the main rule when looking for dividend stocks. And this is not to be tempted by the so-called dividend traps. Just because a share offers a very high dividends, it does not mean it's a great investment. Often what happens is a rise in a company's dividend yield is a function of a falling share price. So companies set a trap for those investors, as some of us may be swayed by a high dividend yield. Let's have a look at an example. This company is called Amigo Holding, and they have an extraordinary dividend yield of 182.53%. But as you can see from their share price, right, it's been drastically dropping. And this graph is a 1 year representation of their share price. This company will probably collapse in the next year or two. Their current share price is only 17p. Now, normally investors say dividend yields over 4% should be carefully scrutinized. A too high dividend yield can indicate the payout is obviously unsustainable, or that investors are selling their stocks, as can be seen here. Now this obviously drives down its share price and increases the dividend yield as shown in the previous slide. Check the company's earnings. Some of you might know this as profit, and revenues. Some of you might know this as sales. Check whether those indicators are growing. So if the earnings and revenues are growing, and you look at the company's debt, make sure they're not overly burdened by debt, and all these factors would have an impact on the payout. So Earnings, revenue, and debt is the key drivers really for a dividend paying stock. Okay. You should also seek stocks or shares that are set to increase their payouts in the future. So this tells you that the company is growing, as the dividends indicates that it will grow in the future. Okay. Companies or groups with a rise in earnings and profits are much likely to be able to raise their dividends because they have more cash on their balance sheet. Okay. So keeping these points in mind, let's go through the top 5 dividend stocks. First on the list is Glencoe. Remember what I said earlier, that profits and sales and debt is important for those companies. But let's just quickly go over the company at a glance. This is mainly a mining company. They have sites in 35 countries. Their marketing adjusted before EBITDA. EBITDA, you don't really need to know what that is 2.6 billion. They employ over 160,000 people, so they're not a small company at all. And when we look at their total revenue, as you can see, this company's revenue has been steadily growing from the year 2016 to 2019, from 158. So these numbers are in millions, just to be clear. So that's 152 billion, right? So from 2016 to 2019, it's been growing steadily, as you can see from these figures, but this year this is due to be impacted due to the pandemic, but it seems like they will pick up in 2021. Let's just go to the profits. Their profits this year and next is estimated to pick up back to 1.2 billion this year and 2.5 billion next year respectively. So a steady growth company. Their net debt has been steadily increasing since 2016, from 30 billion to about 35 billion. Their dividend yield is a solid 8.3% this year and possibly 9.18%. This is estimated to be what it is for 2021. So it's a very steady and attractive company for many different investors. Very large company. They've been around for years and will be around for many more years. So Glencoe is first on the list. Second on the list is Aviva. Most of you are aware of Aviva. This is a multinational insurance company headquartered in London. Let's start with their total revenue. Other than 2018, total revenue being relatively low this year. It's a steady company. Range of around 40 to about 55 billion, which isn't too bad at all for Aviva. So revenue wise, steady, other than 2018 as it was 17 billion. Earnings or profit, as some of you might know it as, this year and next, solid at 2 billion and 2.1 billion for profits. Okay. This is a good steady increase from year 2016 to next year. 2019 was a good year for them, Aviva. I think a lot of people jump on the boat with this company last year. So revenue and earnings is relatively good. Now let's look at their debt. Their debt is a negative one last few years, other than 2018. So a negative debt is a sign of a healthy company. Let's move to their dividend yield. Estimates for this year is 3.47% if they are going to pay it. I believe they're not going to be paying a dividend to their investors this year. However, next year this is due to increase to 11%. Now anything above 10% can be seen as a risk. They're going to be paying their investors really well next year. Okay, so that's Aviva. Let's look at the third one on the list. Is a company called Close Brothers Group. Now this is a UK merchant banking group providing lending, deposit taking, wealth management services. This company employs over 3,000 people and are principally in the UK. They were initially founded in 1878, so they are a very old, well-established company, and these figures will be seen here. Their total revenue from 2016 to 2021 estimates is is a relative one, really small range from 376 million to about 889 million. This year roughly around the 847 million, and set to increase by nearly 20 million for next year. Okay, very old company. Let's look at their net profit. Net profit again, small range, from 187 to about 202 million. This year estimated to be 196 million, and next year 199 million. So really steady company, very old company, well established. Their net debt, again, really small range, 1.5 billion last year, and has been increasing, slowly creeping up, but nothing to really worry about. So net debt is relative. Their dividend yield is pretty good at 6.38% estimate for this year, and next year estimated to be about 6.7. Okay, so like I said, very steady, and that is Close Brothers Group. Right, fourth on the list is a company called Euromoney Institutional. Okay, this is a group which actively manages a portfolio of business-to-business information services. Okay, they provide market intelligence to many of these business-to-business companies, and they have been established for many years. So let's start with their total revenue. Again, relatively small range. Okay, so for this year and next, it's set to grow from 380 to 422 million. So that's a range of about 42 million increase in total revenue. The net profit, again, it's been growing consistently for this company. 2018 was a good year in terms of profit, as this was 195 million, but for this year it's set to be about 69.4 million, and next year about 88.5 million. Okay, so it's a company that makes quite a lot of money for what they do. Their net profit is pretty good when compared to their total revenue. Okay, their net debt, again, good, negative figures. So I said that's a sign of a healthy balance sheet. And last few years it's been really good, negative 78 million and negative 45 million respectively. Okay, so really nice, well looked after company. Okay, dividends, as you can see, this is shown to be pretty low, I would say, for 2019 at 2.97. But the reason why I've shown the 2019 dividend yield is because look at the jump from 2.97 to 4.47. Okay, that's nearly a 2% increase, but that's still a very healthy figure, 4.47 for this year, and set to increase to 4.55. Okay, this is a really good positive dividend yield. Fifth on the list, and by no means the last one, is a company called Vetrix. They are a British-based supplier of high-performance polymer solutions. Polymers can be found everywhere in aerospace and automotive, for example, and many more. Their sales has been driven by their core growth, okay, 10% over the last year, and because they've had strong performances across the industrial markets that they partake in. Okay, so this is Vetrix. Let's look at their figures. Total revenue from 2016 to 2021 estimates is pretty good, relatively consistent, and nice increases from 2016 to 2018. It's come down slightly last year, but it will pick back up again, hopefully this year and next. Okay, so the total revenue looks relatively good. When we look at the net profit, okay, again, nice increase from 2016 to 2018. So last year they got hit slightly, but this year maybe a bit of a loss in terms of net profit this year, but set to pick up definitely by next year. Okay, really good net debt, really nice negative figures all across the board from 2016 onwards. Really good sign of a good balance sheet. Okay, and this is reflected by their dividend yield. Again, wanted to show the 2019 figure because it was a relatively low at 2.3%, but this year it's set to be at a healthy 3%, and next year that will increase to 4.26%. Okay, so just to recap, the list of stocks in this list comprise of finance and industrial companies. Finance companies do not push the boat, i.e., they don't want to ruin their reputation, so they don't really do anything too significant. So they are going to be steady growers, 20 million here and there every year or so. So that's pretty good. And the other one is the industrial companies like Vetrix, as shown last in this list. They're invested in future materials like polymers. And are looking towards the foreseeable future. This is the end of the video. Please do me a favor and subscribe, share and like this video. It tells the YouTube algorithm that these videos are worthy of watching. I hope this video has been informative, and remember, before you do buy any stocks, to do your own research, and I hope you have a good day.